For the last several episodes, we asked one kind of question. Is this a good business? We read statements, ratios, moats. That is fundamental analysis. But there's a completely different language people use to look at a stock, one that ignores the company entirely and stares only at the price chart, the jagged line itself. It is called technical analysis. And today, you get the beginner's map to reading that chart, so the squiggly mess on every finance screen finally starts to make sense. First, what technical analysis actually believes. It says that everything you need to know is already in the price and its history. It does not ask what the company sells or whether it makes money. It asks only, what is the price doing and what does its pattern suggest it might do next? Fundamental analysis studies the business. Technical analysis studies the behavior of the crowd buying and selling it. Two completely different lenses on the very same stock. So let's learn to read the chart, one layer at a time. Layer 1, the basic building block, the candlestick. Most stock charts are not simple lines. They're made of little candle shapes, and each candle tells you the story of one slice of time, one day, say, or 1 hour. A single candle packs in 4 facts. Where the price opened, where it closed, its highest point, and its lowest. The thick part is called the body, stretching between the open and close. The thin lines poking out, the wicks, mark the high and the low. Color makes it instant. A green candle means the price closed higher than it opened. Buyers won that period. A red candle means it closed lower. Sellers won. A whole chart of these is just a running scoreboard of that daily tug-of-war. And here is a lovely piece of history. This technique was invented centuries ago by an 18th century Japanese rice trader named Munehisa Homma, who used it to read the rice markets. The charts on your modern screen are powered by the insight of a man trading rice 300 years ago. Layer 2, and this is the single most important idea in all of technical analysis, the trend. Zoom out from the individual candles and ask one question. Is this chart generally heading up, down, or sideways? An uptrend is a staircase climbing to the right, each peak and each dip a little higher than the last. A downtrend is the reverse, stair-stepping lower. And a sideways trend just drifts flat. Much of this thinking traces back to Charles Dow, the same Dow from the Dow Jones, whose ideas became known as Dow theory. Traders have a famous saying that captures it. The trend is your friend. Betting against a strong trend is how many of them get hurt. Layer 3, the invisible lines, support and resistance. Watch a chart long enough, and you will notice the price often stops at certain levels, like there's a floor beneath it and a ceiling above it. Support is the floor, a price where buyers keep stepping in and the fall stops. Resistance is the ceiling, a price where sellers keep appearing and the rise stalls. Technical traders obsess over these levels, because a price breaking through a long-standing ceiling or crashing through a floor is often seen as a big signal that the crowd's mood has shifted. Layer 4, the volume underneath. Beneath most charts sits a row of bars, the volume, showing how many shares changed hands in each period. Volume is the conviction behind a move. A price rising on huge volume means a lot of people are enthusiastically buying. The move has real force. A price drifting up on tiny volume is a quiet, less trustworthy move. Volume is how technical analysts tell a real surge from a weak one. So there is your starter map. Candles for the story of each period, trend for the big direction, support and resistance for the key levels, and volume for the conviction. With just those 4, that intimidating squiggle transforms into something you can actually read, like learning the basic grammar of a new language. But now the honest caveat, and it matters enormously. Technical analysis is, at its heart, the study of crowd psychology, of patterns in human buying and selling. It is genuinely useful for short-term traders timing their moves. But it is also controversial, and remember the lesson from last episode. The market is fiercely efficient, and no chart pattern is a guaranteed crystal ball, or everyone would simply use it and get rich. For a long-term investor, the kind this series has gently pointed you toward, the fundamentals of a business and the quiet power of an index fund matter far more than any candlestick. Technical analysis is a fascinating tool to understand, especially so you know what traders are reacting to. It is not a magic key to easy money. So look back at that jagged, intimidating line we started with, the one that used to look like pure chaos. It is not chaos anymore. It is a story told in candles, shaped into trends, bounded by floors and ceilings, and powered by volume. You can read it now, at least the first chapter of it. Whether you ever trade on it is a separate, careful choice, but the language itself is no longer a mystery. I'll see you in the next one. Until then, keep it simple, and remember, a chart shows you the crowd's mood, never the future itself.